Hello students, today we are going to learn about raising of finance. As a ABM students, we should know what are the different needs first. To raise a finance, this is a very common activity done by all the managers. As a manager, they need to decide the fund source, why they are in need fund, what are the different sources of a fund, how they can get this fund. That we are going to understand in this particular session. Okay, with the help of PPT, I will tell you how we are going to see a particular different types of fund and with the different objective. Okay, see, today we are going to talk about raising of a finance, different methods. First, to understand a different methods and all, first we need to understand need for a need for and importance of a finance. Means first we need to understand what is need, then importance, that we need to understand. Why need? Because when we are talking about a fund, when we are talking about the finance means what? We are in need of a fund, and that fund we want for a business purpose. And basically why we are in need of a fund? To grow the business. Okay, so first of all we need to understand the need, then we can decide a fund. Okay, and why it is important to decide on the basis of a need? Because we need to understand which particular need required what kind of funds and how much it will affect on a company's performance, that we need to understand. Okay, so we are going to see first of all what is a financial need. The financial need basically categorized into two forms. One is based on a performance, second one is based on a period of use. So first we'll talk about a performance based on performance. Okay, performance means what do you mean by the performance of a company? Means the company you want for a growing or growth, or whether you are looking for a more production, where you are looking for more acquisition kind of it activity, that you need to identify which kind of task you wanted to perform. For that purpose you are in need of a fund, that is nothing but a based on a performance. Okay, so this performance, again you can see for that performance, you again there are the two different way to look at the performance. One is first one is your fixed capital, second one is your working capital. When we are talking about the fixed capital here, student, always remember fixed means what? Which is fixed investment. Means like take an example, if you are starting any business, you are in need of what? Basically first you are in need of a one land, one building where you will conduct your business, correct? Secondly, you are in need of some kind of a machineries, correct? So these are nothing but fixed kind of a things that are required to conduct your business. So this money need to be always there for a long period of time, so that's why it is called as a fixed capital. Okay, I hope you all are with me. Now second one is your working capital. What do you mean by working? First thing is what do you mean by the working capital? Working means what? Work on it, you are working something. So like company, what they are doing? Working, they are doing day-to-day production activity, and related to production they need to do some kind of a day-to-day expenditure. Like they need to produce every day, they need to pay their inventory bills, they need to pay every month the employee's salary, they need to pay electricity bill, they need to pay different kinds of multiple bills which are coming on periodical basis, and these bills are occurred because of a functioning of a business. So that is called as working capital. To work the business, whatever the funds are required, that is working capital. Okay, so understood the based on a performance, one as a fixed capital which is required for a long period and which need to be fixed one, which is not going to be going out. Okay, Working capital which can be fluctuating also. Sometimes the companies need to produce more, sometimes company need to produce less. Now you can see the corona situation, working capital was completely down, correct? So on that time nobody is in need of a capital. But if you see it, suppose I am taking an example of ice creams. In the summer their working capital is on higher side. Why? Because ice cream companies are working more and they are producing more and more ice creams to sell in a market. Okay, understood what do you mean by the best on a performance? Now we are going to see on a based on a period. So here period is also important. Period here from the point of view of a number of years. You are in need of a more number of means 10, 15, 20, even unknown number of years. I am in need of that particular fund. So that is called as a long-term capital. These long terms are always used by your companies for fixed capital. Okay, like you are in need of a building machine, for that purpose always companies prefer a long-term capital. Even for project financing also some part they are in need of a long-term capital. Okay, and then short term capital. Short term means what? It may be for 1 month, it may be for few days, it may be for 1 year, 6 months, quarter, or it may be for 2 years. So that is called as a short term capital. Means it is for a short period of time they are in need of a fund. So understood what are the different financial needs? On the basis of these financial needs you can decide what kind of the funds company should raise. Now when we are talking about the performance, when we are talking about a particular period, so when we are borrowing a fund together, it forms a capital structure. Structure means what? Formation of a two fund. Some are like a particular long-term funds, means they are for unknown period of time that fund is available with the company, and there are some funds they are available with the company for short period of time or known period of time. Okay, means it is called as a borrowed fund. So this kind of a form, it is called as a capital structure, means fund structure. That fund structure again divided into two parts. You can see first one is here a ownership capital. Second one is borrowed capital. Ownership capital means what? The owner. Who are the owner? Equity shareholders are the owner. Preference shareholders are the owner. Debenture holders are the owner of a company if it is a redeemable condition apply. Okay, so it is a ownership capital. Then borrowed capital. Borrowed capital means what? Bank loans. There are the commercial banks loans. These all different loans are nothing but what? Your borrowed capital. Now I hope everybody clear ownership capital and the borrowed capital. Now we'll see different methods. Through that method we can borrow the funds. First one we'll talk about the raising of fund through a different forms for a long period, or it can be a medium term. Okay, first one is issue of a share. Shares, here we are talking about equity shares. Then issue of a debenture, loans from a financial institutions, loan from a commercial bank, public deposit, retention of a profit. We will discuss one by one in coming slides. Okay, here just I have listed all the different instruments through that the long term finance can be raised. Now we'll see a short term financing instrument through that company can raise a finance. Trade credit, factoring, discounting bill of exchange, bank overdraft, cash credit, public deposit. These all are the 5 different short-term sources of finance. Now the same thing here I have represented in the form of a chart. You can see here only I have bifurcated in a different 3 forms. One is a long term, medium and short. In a long term, you can see the same thing which I have discussed in the last PPT, same I have mentioned here. Only retention of a profit and public deposit. These two are having a connection between different terms. Like you can see A retention of a profit is also termed as a medium term capital. Public deposit also can be termed as a medium term, even as a short term capital. Now we'll see one by one. First, we'll start with a long term share capital. Long term financing, in that we'll see first of all issue of a shares. And the issue of a shares, again, there are the different three type of shares. First one is your equity share, preference shares, and issue of a debentures. So first we will talk about equity share. Equity share represents the ownership of a company, and thus the capital raised by issue of such a share is known as capital share or owner's fund. Miss, here you can see the company is going to collect, or you is going to raise a finance by issuing some shares. That fund is here termed as equity shares. Okay. When you are talking about the equity shares, so first every student must know that equity share, they don't have any kind of fixed dividend. It 100% depends on the earnings of a company. Dividend is decided by board of directors of a company. It is 100% company's decision to give a dividend to equity share or not. Even percentage also decided by a company, because indirectly these equity shares are the owner of a company. You can see the third point is the same. They are referred to be a residential owner, since they received what is left after all others claim on the company's income and the assets have been settled. Residual owner means what? They are like owner on the, they are the owner of a business, but they received, when they will receive the particular claim after everybody's claim is over, on income and asset of a company, whatever is left out, that is nothing but the equity shareholders ownership is remain on the particular asset of a company. Okay, but they are also a very means they are also enjoying a very what I can say, growing companies, sweet fruits. Like take an example of a Reliance Jio company. Now the Reliance Jio means Jio, this particular segment is growing like anything, and company is having good profits. Okay, so they are having a good rewards. The company is provided this time a particular right shares, correct? So this is nothing but a reward given by a Reliance company to their existing shareholder, correct? But these shareholder also having a risk of ownership. Risk of ownership. Why risk of ownership? Because if the company is not able to perform better, what will happen? Whatever the funds they are invested already into the different assets, like land is there, building is there, machines is there, on that, or everybody who is having claim, everybody is having a claim. Their particular claims are going to be, first of all, their claim is going to be settled down. If something is left, then it is belong to equity share, and that's why it is a risk of ownership. There may be possibility nothing is left for equity shareholder, so that's why it is a risk to ownership. Then there are liabilities. What is the liability of a share, equity share? Their liability, however, it is limited to extents of capital contribution by them in a company. If equity shareholder has given a 10,000 rupees as equity share, up to that 10,000 only he is having his liability towards a company. Okay, means his belongings, like that particular shareholder is having his own car, bungalow, building and all, the company cannot miss. If the company is going wind up, the company's closure, on that time, that shareholders personal assets are not going to be considered at the time of a wind up. Only up to the 10,000 the liability is restricted to the contribution of a shareholder. Very big aspect here with the equity shareholder is right to vote. Means this share is having a vote of right to vote. They are having a voting right. They can vote in a management. They can participate in management decision making process. If a company is deciding any very important decision, and on that time company need to pass a a particular voting. Okay, this voting plays very important role because this right is only with the equity shareholder. They are a owner of a company. So if the all shareholders are with the management decision, it shows that all owners of a company believe that yes, company's management is going in a right direction and they all are with the company. Okay, so this is nothing but what the equity shareholder. Now we'll talk about the preference shares. Preference share means what? A preference shares which is having a preference, which is having always preference. They are having a preference at the time of a particular company's vendor. These shareholders are getting a dividend which is fixed by a company, and that fixed rate need to be paid by a organization. Is payable only if the company are in a profit. If the company is not in profit, that is going to be accumulated and the next year company is supposed to pay it. But here you see the equity shareholder, they don't have any fixed kind of a dividend rate, but preference, they are having a preference for a dividend. If this year company is not able to give a dividend, what will happen? It will give accumulate and it will get paid into a next year whenever the company is coming in a profit. Then preference shareholder, they don't have any voting right. Equity shareholder have a voting right. Preference, they don't have. They cannot take any cannot take a part into a management decision making process. Company can declare a higher rate of dividend for equity shareholder in good years, but rate of preference is fixed. Like you can see right now, Reliance is booming, so Reliance can provide a higher rate of dividend. There may be possibility preference shares are given a dividend rate of suppose 12, but now the dividend for equity is given 18%. Okay, so this enjoyment is with the equity shareholder. Preference shares rate is once fixed, it is fixed for a period of years. Whatever the period for the preference shares decided, up to that it is fixed one. Then company may issue a redeemable preference shares and have the flexibility of paying off the amount if the necessary, and replace it by some other type of capital. Means redeemable preference shares and non-redeemable preference shares. Again, in preference shares, there are the two type of preference shares: redeemable and non-redeemable. Redeemable means what? After some period of time, this preference shares are going to be dissolved. It is going to be converted into equity. So that is called as redeemable. Non-redeemable means what? The shares are not going to be converted. After some period of time, it is going to be completely minus from a company's capital, and that particular flexibility is with the company, redeemable in case of that. And even company can replace this particular capital with different kind of a capital. This is nothing but what the particular flexibility is in the hands of a company. Okay, now we'll see a issue of a debenture. Debenture, here first we need to understand what you mean by the debenture. Debenture, here the company can borrow the fund by issuing a debenture as a security is of a specific face value. Means debenture have a specific value and it is issued to a different investors. The rate of interest payable on a debenture is fixed. Like a preference shares only, it is going to be fixed at the time of issue only, and they are recovered by a charge on the property. Means this debenture have a particular charge, means they are having a right on particular property or a company's asset, which is which provide the necessary security for the payments. Means whenever you are issuing any debentures, so you need to secure your debentures. Like if I am buying a debentures of particular company, the debentures are secured against any particular asset of a organization. This is specifically again for the investor protection. If the company is not able to perform, I have invested in a debentures, in that case what will happen? The debenture holders are in a losses. So for that purpose, SEBI has given this particular guideline कि whenever you are, means company is issuing a debenture, they need to provide something as a security. Then company is liable to pay the interest even if they are in a no profit, means they are facing a losses, but still the company has to pay a fixed rate of debenture, whatever is a fixed rate is decided at the time of issue. If there is a default in a payment of a interest or repayment of the principal, the asset can be attacked by the order of a court of law. Means as per the order of a court, they can claim on a asset of a organization which is already mentioned at the time of a issue. Debentures do not carry any voting right. They don't have any voting right. They cannot participate into organization. Hence, they cannot be a particular existing promoter for an organization. Hence, the management by the promoters or existing shareholder remains an unaffected. If you see in preference shares and all, so here, in that preference shares is always having a preference for payment. Debenture is having a fixed rate of return and it is not to be paid in the same year. In the preference shares, it can be accumulate and the next year it can be paid off. But in debenture, you cannot do this. The debenture people have a right directly on a company's asset because at the time of issue, it is secured with the help of some asset. Okay. So today we will stop here.